Welcome, 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 everyone. You know, I like to say this: if this topic looks interesting and fun, and you guys are already in the first couple minutes are like, "Whoa, this is great! I wish a few other people from my company would be on." Now's the time. Grab the link, send the link, get them in here, have them join this conversation, let them be a part of this. So go ahead. This is the one time where Christine and I say text, email, call people, let them know we're going to get started here in a minute, but don't let them miss this as they're going to be able to get a bunch of great insights from this. So post it to your team, have them join. All right. Well, again, I'll read the title out so everyone can hear it. Understand that this is a conversation, not just a presentation. So ask questions, engage. You know, we always start with polls. You guys are about to see that. So we're going to get you guys engaged from the minute we get started. You are here riding the equity tide in mortgage finance, wealth strategies for the 2022 Mortgage Originator. I am going to be your host here with, my name is Alex Kosician, co-founder, CEO at Sales Boomerang, and I am with Christine Beckwith, President of Vision for Success. Christine, thank you so much for doing this with us.
Absolutely thrilled to be here. Thank you. And what a way to open the show with that rockin' song. I love it.
Just having a little fun while we're doing a little magic, right? So look, let's jump right into it. As we said, we like to get you guys engaged right away. That way you're looking at the screen, you're listening to us. Don't worry about emails and text messages for a few minutes. Give yourself the space. You joined this webinar to learn. But when you join a webinar to learn, don't just sit back and take information and forget it the next moment. Put it into action. We're going to be giving you guys insights on putting things into action now. So pay attention, take some notes, and take some action. So first question, do you think you know how to coach borrowers to build wealth in this uncertain market environment? While people are answering this question, we'll give them a good 60 seconds to kind of think about it. All of you, come on, everyone, give us an answer. In the meantime, Christine, anything you want them to think about when they're answering this question?
Yeah, I mean, obviously, 2022. First of all, hello, everybody out there. Thanks for joining us and thanks for coming in. I love Sales Boomerang. Love myself a good economic conversation. So I'm really happy to be in the room today on this topic. You know, when I'm looking at the poll question, I think a lot of times with moving markets and depending upon your tenure in the industry, this conversation can feel different, sound different. This is truly where the economics part of your education comes into play. And it's also going to test you because we know the obvious objections that borrowers have in the 2022 market. Based on the way that we've been serving the American homeowner for the last few years. And I'll let you finish the poll and then we can dive in because I don't want to give away the answers before we know.
Yeah, let's do it. Let's see what the results look like.
Saying.
Okay, this is great. Look at this. So
I love that.
13% say, hey, I got this. I'm good, which may be a reflection of their tenure, right? We'll dive into that. I hope you can pull some people out and get them to speak up. Sometimes I do. And as 46% and 42%, I'll take advice on that, please. It's awesome. Yep. So this is great. About 88% of people are saying, look, I kind of do, and I'd like to learn more. So let's get into that before we get into the next section.
Yeah. So obviously, as we wound down in 2021, you know, it was obvious that the economics was beginning to change. And when anyone could see, you know, with the rising rate environment that we were in, that the rate and term refi was drying up. And therein lies, you know, I've ridden along because this is my 35th year in the industry with you originators, having been an originator and in sales my whole career. I know the pain point on the day that the rate spikes and you're sitting on a pipeline and you're going, what now? Therein begins the lie we tell ourselves of looking every day for that rate to come back down. And I think through the fourth quarter, we began to realize there was a monumental shift occurring and that we might not return to where we had been for the past 3 years. And that has happened. And so everybody has kind of compared that rising rate. And I've heard the word recession being used. And obviously the word recession by definition means slowing down. And so here's where the panic button got hit in the fourth quarter and even in early 2022 is a lot of originators started to say, well, man, this is '07 all over again. This is '08 all over again. Well, first of all, I want you to realize completely two different markets. I'd like to spend a couple of minutes unpacking the difference between the two markets because I think it's really good.
Very important.
Yep, you should take notes here because if you want it and you get into these background stories, which the history of economics plays an important role with savvy homeowners, investors. By the way, investors and savvy homeowners are your client this year. We're going to talk about why the pay down, pay off people are not our people this year. And we're going to talk about identifying them early in the conversation and moving on. We're not going to talk about overcoming the mindsets of people that don't have this wealth strategy mindset because it's just like working leads. If you've ever worked leads, you have to identify right away whether you have a convertible lead or not, etc. So history lesson on economics.
So Christine, before you get into the history lesson, two things. So first of all, you just dropped a bomb on us, and I want everyone to hear that. Christine just said you're going to be wanting to focus on home buyers and investors. So that is something Christine is going to unpack and talk about a little bit later on. And before you get into the history lesson, everyone, please, into chat real quick. When you saw this market coming, just so Christine can really talk deeply, when you saw this market coming, did you instantly have flashbacks to 2007, 2008? Put it into chat. Yes or no, a thumbs up, thumbs down, smiley face, frowny face. Let us know how you think. There's Tara saying yes. Everyone chime in. As you get this history lesson from Christine, let's see how many of you already thought that this was going to be a 2007, 2000. Okay, look at that. We have some mixed emotions. Keep going in there, guys. Throw them in there. So
it's
one
good
yes,
I think it's good if you realize that it's not the same, but I will tell you where the conversation will go after we got to lay out what you may know or not know, and we'll assume there's still some details here that everybody should know the differences of whether you were selling in '07 or now. Are you ready for me, Alex,
let's go.
to dive into it? Okay.
Yes.
I think that, and again, they're saying no, they didn't think it was the same as '07, which is good if they know that there is a difference between then and now. First of all, that was a bear market. This is a bull market. But here are some facets underneath the hood where we can go a little deeper in our conversation. In '07, if you go back to '05, the delinquency rate in '05 was typical national average of between 4% and 6%. That means 4 out of 6, 4 or 6 people out of 100 were going into default. And that is how it had been for 20 years prior to '05. And between '05 and '08, the deficiency rate would rise over 40%, which was unprecedented, as we know.
Wow.
And so we had all-time high default and we had low demand. So you had more homes than there were buyers, and you had high default. You had regulatory restriction. You had obviously we were bringing in laws. The entire government system was trying to answer to the angry American consumer, and we were coming in with all these things. Fast forward now, that's that market. No equity, can't sell a house, can't buy a house. People are upside down. Nobody can refi, and that's kind of where you're at. When you come forward to now, we have low default, high demand. We obviously have an inventory issue, which when you sit on that little topic, you can unpack it in a number of different ways and find things underneath the hood of that, including the pandemic mindset, right? So where are the people that were selling in February of 2020? Well, they may have been getting ready to list their spring market homes, and boom, I can bring us back to the first week of March in 2020. And I was waiting for a dinosaur to walk down the street because I couldn't even believe what was happening. And I was grateful that I had a virtual company, and the world was shook. We were all shook, right? And so people began to have their homes as schools for their children, and obviously their businesses. So there's a pandemic effect to the inventory. There are a lot of people that have been held up for 3 years, like bomb shelters, and their houses are not only somewhere they consider their safe haven, and they aren't really ready to sell for that reason, but maybe it's not in its best condition at the same time for the same reason. So there's that effect that's occurring, which is curing. We're seeing that begin to cure with the pandemic declining and numbers declining. house sales are showing some promising upticks now, right now. So you have that going on. So I'll stop here, Alex, let you get a word in edgewise.
No, no, no.
I,
This is perfect. So what you just
yeah,
described is the difference. So everyone that was sitting that didn't answer, didn't respond yes or no into the chat, and you're like, I'm not sure. I still feel like it could be 2018-ish. I mean, 2008-ish kind of. You just heard from Christine all the differences, right? It's the default levels are way different. The demand is way different. This is a completely different market. So do not fall back into the fear cycle that we experienced from 2007, 2008. PTSD is a real thing, but be aware of it. Just be aware when you start falling back into that thinking, just go back to this moment. Remember Christine's face, remember this slide, remember this conversation, and go, this is not the same thing. Do not respond the same way I responded. Now, the question on the poll, we have 88% of people saying they'd like, they're okay, but they're not 100%. And a large portion also said, I'd like to learn more. So do you think you know how to coach your borrowers? Okay, Christine, give us a couple of things right now, everyone on this call that they can use today on a call they're going to have today about a purchase or a refinance, that you can help them turn the conversation from price, as our wonderful friends and partners at Mortgage Coach say, from price to advice, right?
Yep.
From price to advice. How do you give them this advice, and how do you use wealth in the advice to help the consumer go, you're my team, not just today, but tomorrow too. You got to give them something special. So give us a couple things if you could, Christine.
Yeah. So I'm going to tell you, we have a pilot group here of top producers. Top producers here are defined by people that are doing greater than $50 million a year in independent individual business. And so we have dozens of originators that began doing this in November, December, that we kind of wanted to test. And so I want to tell you that we've tweaked this too and figured out, and I'll go straight to the end and tell you, we have big numbers coming in already on these strategies, real proven, because I knew if we were going to go out with these, we had to test them in this market. And we believed in what we were saying. So very first thing is you have to have a bold digital social media strategy or a bold marketing strategy, however you're reaching your clients, whether it's through CRM or it's social media or it's even hard mailer. You are not entering this conversation softly, because here's the thing, it's kind of like throwing a net into the ocean, but you're fishing for a specific type of person. And if your net is too broad, you're going to be sifting through all kinds of fish to find the ones that you can keep this year that are actually doable. And so your strategy has to sound like, hey, give me a call today so we can talk about raising your interest rate and getting you that cash equity and saving you hundreds, maybe thousands of dollars in financial debt and increasing your cash position and wealth. You can do it a number of ways. You can do that. You can move on from that. You can say, hey, have you spoken to somebody in 2022 about why the number one vehicle to wealth is equity and property, and what are you doing with your equity? You could have something simple like,
love that
what
question.
are you doing this year with your equity? Or how is your equity working for you is a great tagline. What is your equity doing for you? And so I just want to say that that's got to be the strategy, because if you do anything different, like call me and we'll talk about cash out refi, it is not interpreted by the consumer. And what you get is everybody that called you last year to lower their rates and your payoff, pay down, as I call them, people who have been listening to grandpa tell them for their lifetime that they got to get rid of that mortgage and pay it off in their lifetime and not leave their kids with debt. And that's their mindset. They are not the people that are going to raise their interest rate. They might feel foolish doing that. And you've kind of got to help them understand that they're sitting on an investment vehicle. So, I'll go a little deeper and tell you, most homeowners that own their home aren't in the investment mindset. Only about 25% of homeowners have an investment mindset. They kind of accidentally figure out as they own their home for shelter that their house is gaining interest and gaining equity over time. And now if you unpack the last 15 years and homeowners that have been buying, the millennial pool, who just started buying in 2019, by the way, those people haven't even been around long enough to understand the 10, 15, 20% years where we gained equity year over year. So what you have right now is a large audience of people that are of the mindset, I need to pay down and pay off my mortgage. So this is where the rubber meets the road in this conversation.
Yes.
And so that's step number one. I have like 3 or 4 more steps, but I'll stop
Okay.
here.
So let's
and let you-
pause there.
Yep.
And first of all, let's just all together say, wow, right? You have 2 tips here right now for all of those, the 88% of you that said, I would like a little bit more. I'm not certain. That shift in the conversation, just that little tweak in what you're asking. And I love, be bold. This year, be bold. Don't be gray. Don't be soft. Don't be like maybes in this. Be bold in your statements and say, yeah, there's Michelle Field saying, wow, I agree with you, Michelle. I'm blown away. If nothing else, everyone that's been on this call for the last 15 minutes has now gotten one thing they can do very different right off the bat. And I love that question. Yeah. What are you doing with your equity? What are you planning on doing with your equity? There was an article, Christine, and everyone that's listening, there was an article that just yesterday, headline, Americans made more money from equity than salaries in 2021. Everyone's equity generated more money for them in 2021 than their own salaries, which was on average, and we'll see a slide here in just a minute, about $55,000. And we know the average salary is not $55,000. So we know that people made more money from their equity. So look, we're going to dive into some of those strategies a little bit more as we talk. And listen, if you're on this call and you're hearing this and you're like, wow, that question, that position is so powerful. I never thought about it this way. Christine has a whole strategy, an entire plan, an entire course for this. So stay tuned as we continue to talk, because we have another question, which is really another poll question. We were talking about how you can help your borrowers build wealth, but check this out, guys. Do you think you know how to build your own wealth in this uncertain market? I know we've never, ever seen this in a conversation before. The audience, we're asking you how well you think you can help yourself. Let's see where you are. Let's see where the confidence level is, because Christine, if I'm not confident I can help myself, how will that sound to the consumer, right? That's hearing me say things like, I think, I hope, maybe, I've seen this work before, right? That doesn't work in this environment, does it?
Yeah.
We need certainty.
Yeah. You even with the pilot that we've been running, I will tell you that the first 30 days was rough with top producers. I want to unpack this. This is top producers. These are people that really, I mean, some of the guys did more than 100 million. There's like 12 of them on the pilot that did more than $100 million last year. And they struggled with what I'm about to unpack the first month, because they had just been, doing it a different way for the last 3 years. If the inbound phone call for the last 3 years was, what's your interest rate? And you were just winning on servicing low interest rate, and lowering the person's interest rate. And that was the driving, focus line of all the homeowners. First of all, the entire American consumer is also in this pivot time. I want to make everyone feel better right now. There are markets when they shift like this, and typically it takes anywhere from 3 to 6 months. We are in the 6th month right now, going into April. So here's the good news. It's about to get better. You know why? Because the consumer's accepting the higher interest rate. They've had time to have this pivot occur. So it isn't just about us turning the boats. We're in the boats. And I say there's going to be a lot of ships this year that get stuck. They have the sales, they have a great ship, but they will not pivot that boat in a direction where that wind is going to catch. And there is strong winds of success in this market this year with wealth. So are you going to be able to make the pivot? I challenge everybody that's listening right now. And if you don't mind, you want to give the poll answer, and then I'll go into the next step.
Let's do it. Oh my goodness, even more. This is amazing. This is truly, truly amazing. Okay. So when we asked the question, could you help your borrowers? There were more confidence in helping the borrowers than helping themselves. Guys, everyone listening, first of all, thank you for being so honest, right? Like that's you didn't have to be, and you were. So this is great because it helps the conversation along. And this is a reflection on the human race. We always feel like we can help someone else better than we can help ourselves, because we are so critical on ourselves. We are so critical, and we're so scared to hurt ourselves that we are less likely to do a great job with ourselves than we are with others. And the poll reflects that perfectly. But 92% say, I know a bit, and can you help me? And so sit back now, truly turn off everything around you.
Yes.
Christine, let's get into this topic. How can I, as an originator, how can I, as a lender, as a branch manager, as an owner of a lending institution, how do I get confident in helping myself? And then I can reflect that back. And tell me, Christine, too, in your when you get into this, how much does me being able to talk about what I've done for myself help my customer gain confidence about working with me? Is there a direct correlation?
Absolutely. And so, this is going to take a few minutes, but this is where the meat of this is going to come from. And I want to just start from a place where I tell you, I know I'm going to get my French hands going. I'm going to tell you that you have to believe this. You may not have done this with your own mortgages, but you have to believe it. I was lucky to have done this my 30 years. And that is never had a 30-year fixed mortgage. Always took the equity at the high tide. I'm going to do a 5th grade math lesson right now because I want to get you out of your heads of objection thinking, because you're already thinking about the things you're going to throw up. And I hope you do. Hope you're bringing me your hardest objections in this conversation.
Put it into the chat, guys.
Yeah, because we really need to answer these common consumer objections in order for you to get to a place where you're comfortable. So I'm going to start from a place. If you were on Wall Street, and by the way, you are on Wall Street, you may be sitting in your home, but you are an extension of Wall Street. You are selling the 10-year treasury, which is how our 30-year interest rates are formed. And it changes every single day. So we're selling on a moving fluid platform, and we forget about that. And we're also selling collateral that is moving, that has a moving target. And so we know price has been driven up by demand this year. So what we know is if you were selling, let's say, Dunkin' Donuts stock, and you told everybody to buy at $25, and along came 2022, the year in this first quarter that suddenly it is now worth $100 a share. It had not been worth $100 a share for 15 years, but it is right now. You would have to make a decision. Let's say you bought some of those shares yourself. That would be you if you're a loan officer with a home and you're a homeowner. Would you cash it in at $100? I think for a little while, you probably look at the market. You'd say, is this going to go higher? Right? Because I don't want to cash it in. That's what people do when they're owning stock. And at the same time, there's lots of questions that come. In homeownership, it's more complex, of course, because you might sell at the high tide this year, but you're leery of buying. That might keep you from selling, which is lending to our inventory issue. We'll talk about that in a minute. But the bigger thing is, how do you get people to come and take their $100 Dunkin' Donuts stock, their homes at this high equity tide, and cash in their equity if they've been trained for 20 years to keep their principal balances down, the rates as low as possible, and pay these off for their kids so they don't leave them in debt? That's essentially who we're working with, right? So what I want to say now is where we are is at the $100 mark in Dunkin' Donuts stock in actual property owned. We're at a high tide of value. So as the person fronting this, you now want strategies out there where you say, what is your equity doing for you, and all the things that we just said, because here's what's going to happen. That Dunkin' Donuts stock is going to go down in the next year or two. And here's the funny thing about stocks and about equity. It is monopoly money, and it is not going to be realized unless you liquidate it. And so I realize what comes behind that is objection number 2, 3, 4, and 5, which is, what if I liquidate the equity this year and then my house value, drops? Well, we've got you, because we're not letting you go above 80%, right? And the industry is regulated in such a way that we keep that nice 20% marker. And by the way, there has never been a time that properties dropped in value greater than 20% other than 06 and 07 ever in the history of real estate. It is an anomaly. So the likeliness of it happening again, and we're not in that same market. We're never going to be in that market again, because we're smarter today than we've ever been. So with this in mind, I would ask you to consider that the risk point on this type of thing is very low. But here's the alternative. Don't do anything. Don't get your equity. Don't take your equity out. And if you don't, next year, when your property value drops by 50,000 or whatnot, it's gone. You are still safe. You didn't do anything. So the alternative is I didn't raise my principal balance up. And I want to take the conversation further in just a second and tell you what we're seeing with consumers. If you fish for the right ones, they want that money. They need that money. They have things for that money, and they know that the time is right, and they know that the clock is ticking on this monopoly money going away.
So Christine, this is fantastic. I mean, honestly, my goodness, everyone that gets a copy of this, I recommend you playing this for your team and getting into this conversation, because what we're talking about is this. We're going to compare this to the Dunkin' $100 stock
Yep.
price. Okay. And what Christine is saying is like, look, we've been trained to hold, right? But Christine is saying you have all of this equity in your home. Okay, everyone on the call right now, you have to be able to talk to your customer and say, here's what I've done as a financial advisor, as a wealth advisor, as a person to the thing that's going to just treat it properly and are conscious of the fact and no longer just the Maslow's shelter, right? That's still there, but it's no longer the only reason you have a home and you buy a home. You buy it in a certain place,
Yep.
you buy it at a certain time, you buy it for a certain reason. Maybe it's near schools, maybe it's whatever. You are consciously, 25% of us are consciously choosing homes, why we buy them, when we buy them, what we do with them. Let's raise that to 80% of us doing this. But it starts with you. And what Christine is saying is this equity that's there now at the highest level possible. If a year from now, 2 years from now, let's not even say 2 years from now, your equity, your value of your home drops, you've just let all of that money go. You have access to it. You've literally let it go where you can take it out now and put it to work for you. And when things drop, again, it's never happened more than 20% since 2007 in the history. You're hedging yourself. You're taking advantage of your equity. And so I say to everyone here, put those things into action yourself so that when you have a customer on the phone, you explain to them, here's what I did for my sister yesterday. Here's what I did for myself. Here's what I did for my neighbor. Talk to them about how you're taking advantage of this market, and explain to them that the smartest people are using, not calling them dumb, right? You're not doing that. You're saying the smartest financial people are doing these things. And guess what? I'm giving you this advice for free. I'm giving you, hey, Mr. and Mrs. Borrower, this is free financial advice from the best minds in the industry, from the best minds in the financial market. So again, Christine, I think you can go a little further. Maybe we give everyone one more tip about how they themselves can create wealth. And then let's go to the next section and we'll talk about what's happening in the market right now.
Yeah. So I think, the number one thing, loan officers this year that get this, by the way, are going to have thin competition. So I will tell you, you're going to go beyond with these strategies, your competition. The competition won't be thick here, because you have to be able to have these conversations. You have to be able to have good conversations where you can figure this out. Building your own wealth is going to come. There's going to be a lot of money to be made by the loan originators that can talk equity and get equity for people with or without debt, by the way, because based on the theory I just told you, there is a compelling reason to grab it right now while it is there and not bet against future markets when it might not be there. And I will just quickly rattle some objections. I saw Pablo ask that question. Yes, when you ask a homeowner, if you go the other direction and we sit down the guy that's the pay off, pay down mindset, and we say, buddy, why do you want to pay off your principal balance? You're reducing your tax deduction by doing so. And he says, I don't want to leave my kids and grandkids with debt when I die. Well, there's another way to do that. That's buying a life term insurance policy. I don't sell life insurance, but I'm going to tell you right now, if I could get $200,000 out of my homes, and by the way, I did this my whole life. When I had a high equity tide, I would take what I could. I would insure myself against leaving anybody my debt if something horrible would happen. So I wasn't going to die and leave all this debt. I had a higher tax deduction vehicle doing so, a payment that I could afford, no debt ever, by the way, because I always made sure my debt was consolidated through the cash out periods that I could grab. And I
Brilliant.
invested the money every single time. There is an article you can Google out there called The Tale of Two Brothers. It was written by Steve Marshall, who's the creator of Mortgage Mastermind in Las Vegas. It was published in 2008, and it shows you the distinct 20 or 30-year trek of two mindsets, the payoff, pay down guy and the guy who strips out his equity each time at high tide. And the difference is $2 million in wealth.
Wow.
And it's illustrated. Okay.
Let's post this article in here, guys, if you can find it. What was the name of it again?
It's The Tale of Two Brothers by Steve Marshall.
Beautiful.
It was written in 2008. He is, obviously a brilliant man, a brilliant industry icon. So listen, it isn't easy to overcome these objections. So early in the pilot, I will tell you, I had loan officers that were coming to me and saying, listen, this guy, that I talked to, he didn't want to hear it. Like, he just got 2.5 last year. He probably could benefit. People can pay off cars and they don't want to, because they don't want to stretch their vehicles that are 5 or 6 years long into in their minds, a 30-year note. Let me give you another tip.
I think it's brilliant to do that.
The average homeowner has their house 32 months. That's a true statistic. So if you ask anybody that's owned their home, how long they've owned their home? 10 years. How many times you refied in the last 10 years? Twice. Well, you're the statistic. I'm going to tell you 8 out of 10 times, because that's the right percentage. It's going to be that they've had their house for 3 or 4 years. They either sold it or refinanced it. So if that is true, you're shortening your car payment, not lengthening it.
Yes.
And you're also getting rid of the monthly debt, and you have liquidity. And here's another last thing I'm going to say is, if the guy that's trying to pay off his mortgage is trying to save the $2,500 in his mortgage, or $4,000 or $5,000 monthly mortgage payment, he's trying to pay that mortgage off, and he's trying to get rid of that debt of $5,000 a month that he's writing for a check. He is now on the slow, long road. If it takes him 20 years to pay that mortgage off, now has no tax deduction, now is paying the IRS the highest income bracket. And by the way, he thinks he won because he's saving the $5,000 a month in his mortgage payment. And now he is literally saving that $5,000 a month, and he thinks he has just won. But what he did is he bypassed $500,000 in equity over the life of 20 years that he never stripped out. He made his life hard during the process, and he didn't have the tax vehicle to not pay out the highest income at that point. And he did that because somebody told him that paying off his mortgage made smart financial sense. The wealthiest people in the world carry the highest, longest mortgages for tax deductions and liquidity. They want the most revolving liquid income, and they get that by stretching the mortgage payment to 30 years. They never lower their terms, by the way. This is the wealth strategies. Sorry, I know it goes against everything you just did for the last 3 years for the consumer, but it just happens to be true.
Love it. And look, again, I will echo this. And I want let's talk about the markets, and then we'll talk about a couple other really cool things coming up. And then, of course, we dropped that the bomb on them about the investors and home buyers, so we're going to unpack that too. But it's something interesting that you're bringing up about auto, and I think this is very important. At Sales Boomerang, we're getting ready to roll out a cool program for banks, where we're going to be able to, the same thing we do for the mortgage side, where we say, hey, mortgage lenders, these people are ready for a loan, and here's what they're ready for right now. You're getting to your customer before they get to the market. We're getting ready to do this for banks and credit unions for their auto customers too. So they're banking customers that could benefit from a refi on auto or a new purchase, or they've been in an accident. Right? Like we have the ability to now tell banks how to help their customers with auto. And one of the things we're positioning there is the bundle. Auto and mortgage bundle it up. It makes so much sense. And everyone that's on here, you need to do the research, get with Christine, come talk to us. Why does it make so much sense? We'll explain it to you, and you should be telling this to your customers. It is a wealth strategy. So many people bypass it, misunderstand it, think it's not. It is a beautiful wealth strategy. I see people reposting the name of the article you're talking about. And so don't forget to post questions for Christine and me here that we can unpack in front of everyone. So let's keep it going real quick.
Yeah.
Purchase market. And then we have this really cool slide coming up about the current market. So let's talk about the current purchase market, what this slide means. But already everyone on this call, you should have gotten 3 or 4 insights, ideas, concepts that already give you miles ahead of what everyone else is trying to think. What do I say to a customer? How do I get them to listen? How do I get them to care? Right here, you've gotten some of those things. And it does start with you knowing how you can help yourself so that you can repeat or refer those strategies back to your borrowers. And it's a sure way, and Christine can confirm this, it's a sure way to keep that client for the next transaction too. Yep. So go ahead, Christine.
Yeah, no, I mean, I'm looking at this purchase market thing, and this will get me going as well, because, you know, I will quickly tell you my theory for, you know, realtor relationship this year is bring the bread to the table, I call it. And that is, we've been bringing home buyers pre-approved, thinking that that is the best way, you know, let's give somebody a buyer. And that's great in a market that's rich with supply. But because we have high demand, low supply, this year, you should be running strategies for people that want to sell their home. You should be having digital strategies out there to say, who wants to sell their home? You want to talk to me about why it's a good time to sell their home. I know the common objections are, I don't want to buy at the high end. They can rent, obviously, for 2 years using capital gains, tax allowances if they're under the age of 52. And that allows them, I think they even raised it, it might be 54. And that allows them to actually, you know, capitalize on the high end of this market. And imagine if you could warm up a guy or a gal that's thinking of selling their home, and they're kind of going through it with you, and hand that over to your realtor as a warm seller. You're literally bringing bread to the table. Yes. You're enriching the relationship with the realtor. You're solving to an industry problem, by the way, you are out there talking to people that are moving real estate, which puts you in prime visibility to everybody doing all the things that bring us business.
Love it. Love it. I mean, bringing, I was talking to one of our clients, Christine, and anytime you bring a referral to your agent, he calls that the golden referral. That's the golden referral, because it will continue to lay eggs and it will continue to build the bond between two of them. So bringing bread to the table, bringing your own referrals to the agent relationship in this market, more important than ever. Christine, we talk about this all the time, where we say to our lender partners that you have more referrals to give to your agents than your agents have to give to you, as long as you know what's happening in your customer base. Mm-hmm. If you don't know what's happening in your customer base, you're super reactive, which is why you go to your agents for referrals instead of bringing them referrals, right? And so what you're talking about is a lot of what we preach at Sales Boomerang is, look, you can no longer, I'll tell you who in this industry knows everything about their customers. Yeah. It's companies like Better.com, Zillow, Rocket. They know everything to know about their customers, and they are bringing those opportunities to their customers and their referral partners. You have the ability to do the same thing. Your customer base, right, is the place right now in this environment where you're going to not just survive, you're going to thrive. And it's important that your customers realize that you're going to be there for them. So you must know this, what you see on screen, that people's equity grew $55,000 on average for the Americans, 29.3% for the entire year, that people made more money from their equity than their own salaries, their own paychecks every single year. You need to know that. Don't let the news tell you what you need to know about your customers, right? When Sales Boomerang talks about what is happening to its lenders, our lenders know this. Our lenders have been on top of this. Our lenders have been ahead of this. They are contacting their customers and they're saying, here's all of the tappable, not just equity, tappable equity, exactly what Christine was talking about. You don't want to put yourself in a bad position. Right. You want to be smart about it. And so here's all the tappable equity. And here's how the last 20 customers we've helped with this have used this equity. So instead of creating social currency, instead of going, you should do this, before you say you should do this, here's what we did for 20 customers this month that took this advantage of equity. What do you want to do with your equity? Do any of these things sound good to you? Yes, paying down my debt. I'm paying 29% interest rate on my credit card. you just said 7 people did that. I need to be
Mhm.
the 8th, because that really hurts me right now. Right. But let them see the solution, because remember, you're making advice that you would give yourself. Give the advice that you would take. Don't give somebody advice to you like, oh, I would never do that. Then don't do it. It will show through your messaging, right? It will
Mhm.
show through your conversation, your confidence. So make sure you believe in the advice you give. But most important is, how can you use this equity? What are the things inside your borrower's equity it's available right now that wealthy people are doing, because they're not afraid to lose, right? They're like, whatever,
Right.
I'm not going to lose. But that's you should not take that position with your borrowers. Your
Right.
borrowers should know the best wealth strategies. Let them know that they can take advantage the same way, right? And so there's many different ways to use this information. And now that you know that your customers have $55,000 on average extra equity just from last year, how are you going to use this information? So Christine, why don't you share a couple of thoughts here, and then we'll go to this next slide, which I think actually talks about exactly what to do with the equity.
Yeah.
I mean, maybe we should just jump there and you unpack it
Yeah,
here.
I see Lisa in the chat is asking, if you sell high now and wait to buy, most people will have to rent for a while. Will paying rent negate any gain they had by selling high? I mean, obviously during the time that you're renting, you don't have a tax deduction vehicle, and you also are spending money that you're not investing, like in a mortgage that would return. But I think the idea here is that you're not going to buy on the high end. You're going to capitalize on the sellout. And so what you're doing is a strategy to put yourself. So there probably is, you lose the tax interest, but it is offset by the fact, if you're buying a house right now that is 100,000 overpriced, or is being overbid, or the price is being driven up through bidding, you're really starting out from a place, I promise you, that whatever rent, and again, it depends on what you rent. If you rent the Taj Mahal, yeah, you probably aren't going to get ahead. If you're smart about, what you're trying to do in this strategy, then you're going to do something modest that, obviously puts you where you need to be, save as much of that capital gain as you possibly can. And that's the only thing I can think of. Looking at this slide, why is equity a wealth building strategy for originator and borrowers? I mean, again, it's a time and a place. We're here. I know there's going to come years in the future where originators are going to look back and say, man, why didn't I catch on to this? I know it's happening by osmosis in organizations right now, because there's enough great economic minded, savvy, educating originators that are talking amongst the rest of you that might be scared to try to overcome these objections that your borrowers are going to put up, that you might not wholeheartedly believe in until you let this marinate. What I'm finding is that everybody needs to do their own research. Everybody needs to go out there and figure this out. They need to know that this is really smart to do. You need to have financial advisors as well. And by the way, you need to lead with your financial advisors. If you're going to have people out there that are going to help, bring in FAs to do classes right now. In a wealth market, you want financial advisors talking to homeowners about, what should I do with my equity? You want to stay out of the way of giving advice there, by the way. I mean, our licenses limit us to a certain degree, and then it goes beyond. You might even say something. I think I would probably say, contact a good financial advisor. I don't know that I would give them even a name of a person, but I would bring in a financial advisor to educate and make sure that this was the way I was talking this year, that I was fishing for these types of folks, that I was making people ask themselves, what is your low interest rate, low balance loan doing for you this year? Because let me tell you what wealthy people are doing. They're cashing in on a high tide of equity. And even without debt, they're raising their interest rates marginally to capture this equity tide while it is still here for
Wow.
future investment. It's a different conversation. And you got
It's
to
a
get
different
used to having it.
conversation,
Yeah.
but it's such an important conversation, because when you have this conversation with your borrower now, your borrower understands that, oh my goodness, this person will advise me to get me wealth out of this property, not just today, but it sounds like this person is going to advise me moving forward.
Yeah.
And that's really important, because again, I've joined the industry. I don't have the experience you have in the mortgage industry, Christine, but in a very short amount of time, in 5 years of being here, I have realized how valuable, how important equity is, how valuable, how important it is to understand that you're living in a financial vehicle. You're not living in a house that's just protecting you from weather. You're
Right.
actually sitting in a financial vehicle.
That's
And
right.
I find myself a pretty savvy businessman. Like, I've started previous businesses. Like, this is not my first, I had no clue about this. I thought home ownership and mortgages were, I own a home, I sell a home, hopefully I make some money and I put that money towards my next home. That's it. That's all I thought mortgages were. Way off, totally off. Look at this list here. When you have equity, okay, think about this. Everybody in here, I want you all to put into this chat right now, real quick. And I have some other questions that are in here, Christine, I want to bring up because I think that's more important than the next slides that we have. So I want us to go back and actually answer questions, then go into the next slide. So let me talk this through, and then I want to get to some of your questions here. When you know your customer base has these events going on, when you know your customers have equity, not guessing, but knowing with certainty, again, a little, promotion here for the Sales Boomerang platform, no more guessing, you know exactly what's happening. Things you can do, for instance, very simple, removing mortgage insurance. I know this is silly. I know this seems silly, but this is a strategy. When you have equity, you want to help your customer. There are so many people that bought homes over the last few years that put money down, that may have access to remove mortgage insurance, but they don't know it. And if you don't know it, you might be marketing to them, saying exactly this. Hey, you remove your mortgage. You are speaking to everyone. When you have a partner that tells you who to talk to, hey, Alex, guess what? I just got this health check on your mortgage, and it says I can take this $118 off your payment tomorrow. Let's do this for you. That's a great strategy, right? Paying down your high interest credit cards. Oh my goodness. This is huge. This is so important. You have a partner that can tell you your customers have credit card debt, exactly the amount of debt they have, their current credit position, are they qualified, and the amount of equity they have to pay down that debt. No more guessing. You don't have to guess. Laser focus on who could use your services today. That's the reason Christine and Sales Boomerang are doing this right now. We're talking about this. It's so important to not allow the big fintechs, the better.coms of the world, to be the ones talking to your customers. You have the exact same access to this information. Investment in new property. Christine talked about this. So important. Take the cash out, pay a little bit more in interest, but you now have an investment property that's going to get you back 20x what you took out. Right? Yeah. That's the point. But you got to have those conversations. Home buyers and investors. How do you identify them? Christine can probably tell you that an investor may look like this. They live in a house like this, in an area like this. And if they look like this, they're a good person to have a conversation with right now. Paying for school and tuition. Guys, if you know they have $190,000 in tappable equity and they're paying 8%, 9%, 12% on their tuitions, save them from this tragedy. Save them right now.
There's no other vehicle that you can get at this percentage rate. I mean, there is nothing. And in every way that you'll ever invest, this is the best, lowest vehicle to do so. And here's an interesting thing, because we know that loans are only 3 years old. If, an average, if they take this money and we end up in the averages where we're selling or we're refinancing again, assuming in another 3 years, we have another 15-20% equity again, and we're in an even further position. We literally are now wiping out the higher principal increase that we might have had through the debt consolidation now. And so, again, it's crazy to not take advantage right now. And let me tell you something. Don't assume your borrowers are they are probably sitting out there right now having, most Americans did the refi in the last 3 years. They may be feeling silly in their heads about raising their interest rates. And so I think when you lead with that strategy, call me today and I'll tell you why the wealthiest people are refinancing in 2022 and grabbing their equity, consolidating debt, or just grabbing their equity. And I just think you got to start that conversation and give them permission to do so. So I went back and looked at the questions for us.
Yeah, let's go to the questions. So there's one question that said, and I want to just bring this up. I thought it was really interesting. Let me find it for you. There was a question about, should I take the risk of using equity to do renovations and increase my payment? Should I take that risk, Christine?
Yeah, I mean, I think there are things that you can do for renovation that have clear historical gains in equity in your homes. I mean, bathrooms, kitchens, like what are you doing? If you're telling me you're going to dig a new, leach field, I might not tell you that that's going to gain equity. So I mean, there's a lot underneath the hood of that. What I would tell you is you always want to invest in the value of your own property. You want to invest in other properties. So that is a little bit of a difficult answer. But again, you have to let what you're going to hedge against is the future of gain on the vehicle. And
but you said something important, Christine.
Yes.
I think it's important to answer that question. Do I take the risk? Yes, if you're investing in the
Yes.
the value of your property. If you are deciding to build a paint studio in your in your 2-bedroom and turn one into 2-bedroom into a 1-bedroom with a studio for painting, don't do that. That's a bad idea.
Yeah.
But if you're saying, hey, I want to convert my basement that's unfinished into a finished basement and add a full bathroom with a shower. Oh my goodness. Absolutely.
1000%.
1000%.
And there's so many things like that will add to the value. And you're, again, finishing the previous sentence, you're hedging against a future of gains because we are not in a declining equity market. We're in a place where we're going to still, even if this high tide tapers off, and there's been lots of articles about whether the bubble will pop or not. Well, it's going to come down, but it isn't going to crash. It definitely isn't. And looking at the next 5 or 10 years, based on demand alone, by the way, the millennials are projected to buy for 10 years and they're on their 3rd year of buying. So we have the tailwind of that. And then behind them, we've got the Gen Zers coming up and predictions there as well. So we're in a really good place, with all of that. It's just really, these are the strategies that everybody needs to pivot to. I keep saying to all the loan originators that are getting coached here that you have to think hard about the strategies. This is the Success Toolkit that we use and teach by. It has 9 points. We spent the right time on equity strategies today, so I'll just really say this, quickly. We obviously operate from a place, and I'll share this with you so it's a takeaway, where we understand where the future is going, but we keenly understand where we are. That's the future and the current. When you understand the difference or distance between those 2 points, and you can set your goals accordingly, and you can lean into where the markets are going, this year is going to turn you out an expert. This year will make you a formidable mortgage originator. If you've only been a loan officer for under 15 years, this is the market that's going to give you that badge on your shoulder. And this market will come back around. By the way, I've sold into this market 4 times, this type of market exactly in 35 years. It was fun. It took me a minute to pivot. I had great leaders that told me to do so, just like Sales Boomerang is doing for you. I could not say more, and I'm not being paid to say so, that your digital strategies, like having a virtual assistant like Sales Boomerang to help you do the things that you don't have time to mind your databases, mine those, and make sure that it's being done thoroughly. This is the time that I'm telling everybody that's working with me that they need to have more of that, more power to bring more people into this conversation. Know who your key stakeholders are. I always say, surround yourself by the people that will lie for you. Surround yourself by the people that are going to help you get where you're going.
Christine, great question out here.
Yeah.
And I want to ask it. Tara asked this question. She said, if a client just did a refi in January of 2021, does it still make sense to pay all those closing costs?
It does, if it puts them in a position, again, to grab. I mean, again, this is a common objection. Like, people will say, I'm paying closing costs twice. Well, here's the question I would ask you. Will you give me $5,000 today if I'll give you $100,000 tomorrow? And what if you don't do it? What if you don't pay me the $5,000 because you're trying to save on a second set of closing costs? And 1 year from now, that equity has dried up. You no longer have the chance to give me $5,000 for $100,000. And maybe that's the high end of something. Maybe people are getting $25,000 in equity, and that's what they have to get. I would still argue with you, where are you going to spend that money? Financeable, so not out of pocket money, leveraged asset, leveraged debt into the financing of a refi, and then handing you $25,000. Here's the alternative. If you needed $25,000 for college, for debt consolidation, paying off loans, where would you go get it right now if you didn't touch your mortgage? Well, you get a personal loan, which would be a higher interest rate. Maybe you take it from your credit cards. I don't know, super high interest rates. But one thing I do know is this is the lowest possible vehicle that you could possibly be in. And in the history of rates, you know, I started in a market that was at 14%. And I thought we were done for when we got to 10. I thought, where can we go from here? So when I saw the 9s and the 8s and the 7s and the 6s, I mean, I'm still saying, like, where can we go from here? So, you know, 5s are incredibly low interest rates in the big picture of the American market history.
I love that. And so, Tara, I hope that helped you. Yes, we say yes, refinance, explain to them why. Don't just say you should do it. Don't just, and remember, when somebody says, I don't want to have another $5,000 closing cost, they're looking at the whole and they're missing the donut. Okay. There is so much, you're getting 100,000 for that 5,000. Let's just be clear. And if you put that 100,000 in the market and the market performs at average levels, I'm just saying average levels. Let's not even talk big levels. Let's just talk, you get a 5% return on the market over a course of the year. Come on, the first year you paid off that 5,000, just the first year. And let's say it continues to do that. You still have your house, and now you have money in the market, in real estate, either in the markets directly. If you're smart with it, what Christine is saying, everyone, is it's leverage debt. It's not just let me borrow from a bank. That's not leverage debt. Hey, bank, let me borrow from you $100,000. No, you got to pay that back and some. Right. Okay. This money goes to work for you. Okay. And you have it leveraged against your property. So Christine, this was amazing. Couple things for everyone on here. We will get you guys a recording. We'll get you guys that article. Do not miss the opportunity to contact Christine. Get on a call, email, text her, visit her website, talk to her. If nothing else, spend a little time with her and her team and understand if this is something you want everyone in your company to know. Okay. Top producers, mid producers, new producers. This is information that will help them personally. And of course, when you help yourself, you can help many others. And then for everyone that is struggling, understanding how to keep their volume, how to keep their units, your customer base is your most valuable asset. You're going to give agents more information. You're going to give your team more information. Sales Boomerang will give you that. So if you liked everything you heard, find me too. There's my email. There's our website. Like, reach out to us. We are here for the industry. We put this on not because we want you guys to spend money with us. We're here because we want you guys to help the industry. And by helping the industry, you're helping the customers of the industry, which, by the way, is us. Everyone on this call is a customer of our own industry. Yeah. We are our own customers. So we should be helping ourselves. And by helping ourselves, we're helping our customers. So Christine, always a pleasure. I learned so much from you every time we spend time together. And the way you deliver everything with such passion and no expectations of anyone, taking action on this other than I'm doing this for you, and you do it so eloquently. And so I just thank you for your time. And just a pleasure being around you.
Oh, I'm glad to be here while you're here. I'm in the swan song of my decade of my life, and this field has been incredibly wonderful to me. I just got my first Lifetime Achievement Award, and Laura Brandeo was sitting next to me laughing from a company a few months ago. And so I guess I'm in that era. So I'm glad to give it to you. Use it, please. Put it to work for you and let it make it money. So thank you so much, Alex, for
my pleasure.
Me.
Christine, I know the entire industry and every borrower in this industry would be grateful to know that people came to you and took your information and put it to good use. And I hope they do. And so thank you again. Thank you, everybody. Thank you, team, for putting this together. And everybody go out there, have fun and crush it. Christine, thanks again.
Thanks again.